Hello everyone. I'm going to talk about the topic equilibrium of the firm, which is in the fifth module. So, to understand the price determination of a firm and also the industry in any type of market I mean over here the markets which are classified on the basis of degrees of competition. It can be perfect competition or monopoly, a monopoly market or monopolistic market or oligopoly. So to understand the price discrimination under any type of market, the knowledge of equilibrium of firm is very important. Let me try to give the distinction between the two important things over here, firm and an industry. What is firm here? Firm is an individual unit of production, whereas industry constitute the group of firm. This is the basic understanding or basic distinction of firm and industry. Coming back to the next point, equilibrium. What is the equilibrium? The term equilibrium refers to a position of balance, a position of rest, or a position of no change. So we need to also try to understand that when an individual firm will attain that particular tendency, the tendency of not changing, a tendency of remaining in balance or remaining in rest. A firm will attain this particular tendency when it maximizes its profit, when it has no tendency to further maximize the profit with whatever the revenue or with whatever the cost it incur. So, having said about the meaning of firm and also equilibrium, let us move towards for the certain important aspects of equilibrium firm. So, for the sake of simplification, economists consider the three important assumptions to explain the equilibrium of firm. So, the first assumption being, it is assumed that the entrepreneurs are rational. The rational I mean here is that the rationality here refers to that they know that how to maximize the profit. They know that the major motive of business is maximization of profit. And the second important assumption over here is about the firm produces only one product. Okay, it is assumed that firm produces only one product. And the third important assumption also says that the firm is completely aware. It is adequate about the methods of maximizing profit, about the how it will get the maximum revenue by minimizing the cost. That particular understanding, the firm has the adequate knowledge. So keeping these three important assumptions, equilibrium of the firm can be explained. So I'll tell you the understanding of the meaning firm and the industry, understanding of the term equilibrium, and where the process or the assumption on the basis of this equilibrium of the firm is explained. I've told you three. The first one being the rational entrepreneur. Second one, adequate knowledge about the maximization of profit. And the third one, that the firm produces only one product. Yeah. So there are two important techniques to explain the equilibrium of firm. There is one important technique, that is TC and TR approach, and the second important technique is the MC and MR approach. Talking about the TC and TR, in the previous module you have learned about what is total cost. The cost, money incurred by the businessman or to acquire a product, to acquire a service. So the cost further divided into various other type. There is TC, total cost, average cost, and marginal cost. These are the basic classification of cost we come across here. Total cost being the cost incurred or all the important. It is inclusive of variable cost and it is inclusive of both variable cost and the fixed cost. And about the about the AC, that is the average cost per unit of production, and MC is the cost for the cost incurred by the firm for the additional units of commodity. So here, coming back to the TC, I told you that total cost is inclusive of TC is equal to TFC plus TVC. It is sum of total variable cost and total fixed cost. The two techniques of explaining equilibrium of the firm is TC and TR approach and MC and MR approach. Before going to the MC and MR approach, which is adequately adopted or which is extensively used by all the economists, all the economic literature, I would like to also talk about TC and TR approach. TC, total cost, TR, total revenue. Total cost is inclusive of total variable cost and total fixed cost, and TR is a total income earned by selling all the units of production. So the TC is a summation of TFC, that is total fixed cost, which remains constant at the any level of production, and TVC, that is total variable cost, which starts from zero level and increases with the increasing level of output. And what is TR? It is the income earned by the total or by selling the total quantity of output. And we have in TR we have AR. AR is nothing but the revenue earned by the firm per unit of output, and MR I'll discuss later on, MC and MR approach. Looking over here, it is very much visible that I have taken the units of output in the first column, that is units of the output goes from unit 1 to 10, and TR, total revenue. The TR, the total revenue increases with the increasing level of output. It was the total revenue was 200, increased to 475, then to 725, then to 1700 and 1775. The TC also, as I have told you, that TC is a summation of TFC and TVC, wherein the TVC increases with the increasing level of output. Here also the combination shows that the TC also increases with the increasing level of output. Now, what is the profit of the firm? Profit is nothing but the difference between TC and TR. So the calculation goes like this. For the first unit of output, the profit is minus 100 because there is no profit over there. And for the second unit also it is 0, because we need to also understand that even in the 0 level of output, total fixed cost has to be incurred by the firm. That's the reason it remains 0. Then the total profit increases with the increasing level of output, which can be explained with the help of a diagram. Yeah, this is a this is a diagram to explain the equilibrium of firm with the help of TR and TC. In the OY axis, the total revenue and the cost is taken. In the OX axis, the levels of output are taken respectively. There are two important firms you can see at that. The TC curve increases gradually. Yeah, and it has an increasing point. But the TR curve increases, it reaches to the maximum point and start diminishing. And there are certain level of output given. We look at that, the first level of output at OL level, the TC curve intersect the TR curve at the point R. So what is the point R over here? R is a point where the firm doesn't incur losses, no profit, no loss point, which is also called as break-even point at the level of output OL. Then what happens at the OL? The firm tries to expand the levels of output. It will expand the production techniques. It will try to outsource the material. It will try to employ the more and more labor. So you know that the very assumption of the equilibrium of firm also says that the firm is very adequate, but the first important point, the maximization of profit, and firm is very adequate with the knowledge that unless they do or they expand the levels of output, they cannot maximize the profit. So it is very much evident in this particular diagram. The firm expands is the level of output, expands its business, expands its production, and at the OM level of output, you can look at over there the TC, the point, the dashed line or the dotted line between P and Q represent that the total cost is less than the total revenue. So of course that's the difference between profit. It's a point where the profit is higher. After that, what happens? The firm further starts increasing its levels of output, levels of production. It further increases. But at ON level, again the TC intersect the TR, but it will not be very favorable for a firm, because after that point, the total cost starts increasing. Total cost starts increasing. So at the ON level, the S is a point of intersection between the TC and TR approach. And I'll go back to this particular table, which explains us about TC, TR, and profit of the firm, which explains the equilibrium of firm with the TC and TR approach. You can look at over here from the level of when the level of output was 1, the total profit was negative. When the output they expand to 2, the total profit again it is 0. Then afterwards, with the expansion or with the increasing levels of output, the profit increases. And when at the 8th, or you can look at over there, at the 7th unit of output, the TC started increasing, the total cost started increasing. That's the reason the profit falls down. And after that, in case if firm expands, obviously the total profit reduces. That's what is explained in this particular approach, that is TC and TR approach. One thing I need to know, I want to also tell you that getting or explaining equilibrium or finding equilibrium point as per this approach is a little difficult, because we need to always find the dotted line, and the difference between TC and TR will be the equilibrium point. Then that because of the difficulty in this, and also one of the major drawback of TC and TR approach is also that they will not consider the average revenue of a product, or average revenue of a product. Hence, another very widely accepted, very extensively used approach we have to explain the equilibrium of firm, which is widely used even in our market forms, is MC and MR. Marginal cost and marginal revenue. What is marginal revenue? It is a revenue enjoyed from, or it is the income earned by the firm by selling the additional unit of output. When I say that, I can even give you the algebraic formation or form of MR. MR is equal to TRN minus TRN minus 1. What is TRN? Total revenue of number of products minus total revenue of number of products minus 1. What is MC here? Again, it is the cost incurred by the firm to produce one additional unit or additional unit of output, that is MC. So let's explain about the equilibrium of MC and MR approach. Look at over here, the MC and MR, AC and MC. MC, yeah, marginal cost, and AC is average cost, and average revenue and marginal revenue. So here the marginal revenue fall below the average revenue. So this is the important diagram which explains us about the equilibrium position. So coming back to this, yeah, here what is the level of yeah. And one more thing we need to know over here, the point of equilibrium over here is about the point E. Why E is a point of equilibrium? E is a point of equilibrium. E is a point of equilibrium because the MC curve intersects the MR curve from the below. At the point E, MC curve intersects the MR curve from the below. But after the point of equilibrium, the MC curve falls above the MR, which shows about the firm incurring losses. If the marginal cost exceeds above, or if the marginal cost exceeds the marginal revenue, it shows about the losses. If the marginal cost falls below the marginal revenue, it talks about the profit. Hence, it is considered that the point of equilibrium is E, the point where MC is equal to MR, and also it's a point where the MC curve intersects the MR curve from the below. Yeah, and the total or the equilibrium quantity or the suitable quantity for a firm to produce to maximize the maximize the profit is OM. And at the OP price, the firm produces the OM quantity of OM quantity of products at OP price. OP because Q is a point on the AR. AR is nothing but the price over here. Yeah, and the connected line over there, the point on P explains this about the equilibrium price. So OP is the equilibrium price, OM is the equilibrium quantity, and E is the point where the MC curve intersect the MR curve. So it is very much given over here that MQ is equal to OP into OM. That makes that OPQM. Yeah, and the TR, these are the various points with regard to the important thing that is about the equilibrium of firm with the MC and MR. So students, you need to understand that these are the two important approaches we follow in economics to explain the equilibrium of firm in any type of market. As I told you earlier, TC and TR is not that widely used because of certain limitations, like it doesn't consider or it will not take into consideration of average units or the changes per unit, revenue per unit, cost per unit. Hence, the economists stick on to the alternative equilibrium approach, that is MC and MR. Further, in our classes, all the market structure, in all the market structure, the price and output determination will be explained on the basis of MC and MR curve.